Dear students, myself Naresh Kumar Dogra. In our previous video, we earlier had discussed various types of accounting ratio. Now today, we are going to discuss the calculation part of various types of accounting ratio. Today, we will discuss liquidity ratios, and under the liquidity ratios, we are going to calculate current ratio and liquid ratio, also known as acid test ratio or quick ratio. Under the calculation part, we are going to solve various practical problems from NCERT book. So here we are. We have taken an illustration from NCERT book. First illustration for the calculation of current ratio. As per the illustration, the information that is given: inventories rupee 50,000, trade receivables rupee 50,000, advance tax rupee 4,000, cash and cash equivalents 30,000, trade payables rupee 1 lakh, and short term borrowings rupee 4,000. On the basis of this given information, we are supposed to calculate the current ratio. Now, for the calculation of current ratio, the formula is current assets divided by current liabilities. For calculating current ratio, we have to divide current assets with the current liabilities. Now, we have to solve this. Firstly, we have to calculate current assets. So, current assets are inventory rupee 50,000, trade receivables also rupee 50,000, advance tax is rupee 4,000, cash and cash equivalents rupee 30,000. So this will be 1,34,000. Now the current liabilities: trade payables rupee 1 lakh plus short term borrowings rupee 4,000. So this will be 1,04,000. Now we have both current assets as well as current liabilities. So on the basis of this, we may calculate the current ratio. Therefore, current ratio is equal to 1,34,000. These are your current assets. 1,04,000. These are your current liabilities. Now we got 134,104. Now we have to further subdivide it. Now, if we divide it with 2, we will get 52 and 67. So 67 divided by 52. Now we will further subdivide this. So we will get 1.29 ratio 1. This will be your answer. The standard ratio for current ratio is 2:1, but we had arrived at the current ratio 1.29:1. This is what the illustration number 1. There is another practical problem taken from NCERT book. In this practical problem, a balance sheet is given consisting of equity and liabilities section. Under it, there are shareholders funds and current liabilities, and in the assets section, there are non-current assets and current assets. On the basis of this balance sheet, we have to calculate current ratio as well as acid test ratio. Now we will take another question from NCERT book. In this question, a balance sheet is given. In the balance sheet, we are having all the current assets as well as current liabilities. So on the basis of that information, we have to find out the current ratio of a company. So first of all, rub it. Now in this question, again we have to calculate current ratio. Now if you go through the balance sheet, the current assets are given. These are inventories rupee 55,800, trade receivables 28,800 and cash equivalents 59,400. So firstly, inventories 55,800. So we have to calculate current assets first of all. 55,800. These are your inventories. Then trade receivables are 28,800. 28,800. Then we are having cash and cash equivalents 59,400. 59,400. So our current assets will be 1,44,000. These are your current assets. Similarly, we have to calculate current liabilities. So current liabilities in the balance sheet are given trade payables rupees 72,000. 72,000. Now current ratio. Therefore, current ratio. Current assets 1,44,000 and current liabilities are 72,000. After calculating, we will get 71 twos are. This is 2. So we will write it 2:1. This is current ratio equivalent to the standard ratio 2:1. After calculating current ratio, now we have to calculate quick ratio. Quick ratio is also known as liquid ratio. Also it is termed as acid test ratio. Here the more liquidity of the assets is taken into consideration. For the calculation of quick ratio, the formula is quick ratio is equal to quick assets, also known as liquid assets, divided by current liabilities. For calculating quick assets or liquid assets, the formula is current assets minus inventory and prepaid expenses. In this way, we may be able to calculate the liquid assets. From the sum total of the current assets, if we deduct the inventory or the prepaid expenses, then we will get the quick assets. In other words, we can also term it as quick assets can also be calculated after excluding the stock, that is the inventory and prepaid expenses. Now again we will take the first example that we have taken for the calculation of the current ratio. The figures are inventory rupee 50,000, trade receivable 50,000, advance tax 4,000, cash and cash equivalents rupee 30,000, trade payables rupee 1 lakh and short term borrowings are rupee 4,000. This is the information that we had used for calculating question number 1. Now on the basis of the similar example or similar information given, we will calculate the quick ratio. In first question, we had calculated the total current assets rupee 1,34,000. This is what we had calculated in first question. So if current assets are 1,34,000, out of it we have to deduct inventory, which is rupee 50,000, and prepaid expenses. This is what advance tax rupee 4,000. 1,34,000 minus 54,000. We will get 80,000. Current liabilities, already we had calculated in that question. Again we will calculate. Current liabilities are trade payables rupee 1 lakh and short term borrowings are rupee 4,000. This is 1,04,000. These are your current liabilities. Now for calculating quick ratio, so therefore quick ratio or liquid ratio, quick assets 80,000 divided by current liabilities 1,04,000. Now we will divide this, we will get 80 divided by 104. Now again we have to divide 80 with 104, then we will get 0.7688. It will go on 1. We will round it up, 0.77 ratio 1. Now, as per this information that is given in this question, the quick ratio is 0.77 ratio 1. The standard ratio is 1:1. That means our quick assets must be equal to current liabilities. The ratio should be 1:1. If ratio is higher, that means the firm is more solvent in order to pay its current liabilities or say short-term liabilities. And if the ratio is lesser, that means firm is not financially sound in case of to meet its short-term obligations. This is the quick ratio. Yet we will take another question from NCERT. In this question, we will calculate both current ratio as well as quick ratio. The question is, current liabilities are given to be 50,000, current assets are 80,000. Inventories are be 20,000, advance taxes will be 5,000 and prepaid expenses are be 5,000. On the basis of this given information, we have to calculate current ratio as well as quick ratio. So first of all, we will calculate the current ratio. For calculating current ratio, the formula is current assets divided by current liabilities. Now, current assets are given rupee 80,000 and current liabilities are rupee 50,000. So straight away we will mention the figures. 80,000 are your current assets and 50,000 your current liabilities. After the calculations, this is 8 divided by 5. Now 8 will again be divided with 5. Or 1 is a 6. 1.60 divided by 1. The ratio is 1.60 ratio 1. This is your current ratio that we had calculated on the basis of information given. Now, on the basis of same information, we have to calculate the quick ratio. Quick ratio or liquid ratio. The formula is liquid assets divided by current liabilities. So liquid assets or quick assets are to be divided with the current liabilities. Liquid assets are current assets minus inventory and prepaid expenses. Current assets 80,000, that already given, 80,000 minus inventory. Inventories are rupee 20,000. Prepaid expenses. Prepaid expenses, there is advance tax rupee 5,000 and prepaid expenses itself rupee 5,000. So two prepaid expenses are given. Advance tax being a prepaid expenditure and prepaid expenses 5,000. So out of 80,000, we have to deduct 30,000. Now quick assets are 50,000. Therefore, liquid ratio Liquid ratio, liquid assets which are rupee 50,000 divided by current liabilities. So current liabilities are rupee 50,000. This is 1:1. The quick ratio we had calculated 1:1. This is equivalent to the standard ratio 1:1. That means the firm is financially sound in order to meet its short-term liabilities. This is how to calculate the current ratio as well as quick ratio. Here is another illustration that we had taken from NCERT book for the practical problems. In this illustration, the current ratio is given, that is 2:1. Now we will have to give reason which of the following transactions would improve, reduce or not change the ratio. Certain transactions are given. We will have to find out the impact of these transactions in the current ratio, like payment of a current liability, purchased goods on credit, sale of a computer having book value of ₹4,000 and have been sold for ₹3,000 only. Sale of merchandise, that is goods, costing ₹10,000 for ₹11,000, and payment of unclaimed dividend. So on the basis of these transactions, we will have to show the impact of these transactions on the current ratio 2:1. Another question from NCERT. As per NCERT illustration number 6, the question is current ratio is given 2:1 and different statements are given. So this is termed as the statement question. Payment of current liabilities, purchase of goods on credit, sale of a computer having book value of ₹4,000 for ₹3,000. Sale of goods, cost price ₹10,000 and selling price is ₹11,000. And payment of unclaimed dividend. So these transactions are given. Now we will have to show what effect will be there of these transactions on the current ratio. Current ratio is given 2:1. So if we will go through these transactions, so what will be the effect of these transactions on the current ratio? Let's start it. Current ratio this is given 2:1. This consists of current assets and current liabilities. That means the current assets are twice of the current liabilities. Now let us assume current assets is equal to ₹20,000 and current liabilities ₹10,000. On the basis of the given ratio, we had assumed current assets to be ₹20,000 and current liabilities ₹10,000. On the basis of this, the ratio will be current ratio is equal to current assets ratio current liabilities. That means current assets are 20,000 and current liabilities are 10,000. Now the first transaction is payment of a current liability. First transaction, transaction number A, payment of current liability. Now amount is not given, so let us assume that amount is ₹5,000. Let ₹5,000. So if we make a payment of current liability, this will decrease our current assets because cash will be going out, so this will reduce our current assets. So current assets will be reduced by ₹5,000. And current liabilities, we are making payment to our creditors or other current liabilities, so that will also reduce our current liabilities. So 5,000 will also be deducted from the current liabilities. Now the left out amount is 15,000 is the current assets and 5,000 is the current liability. On the basis of this, the new ratio can be formed. New ratio. This is 3:1. That means current assets 15,000 divided by 5,000 current liabilities, the new ratio will be 3:1. Earlier the ratio was 2:1, that is before the payment of current liabilities. Now after the payment of current liability, the new ratio is 3:1. So this is what? This is the increase in the ratio. So this transaction will improve the ratio. So this transaction will improve the ratio. Now we take another transaction, purchase of goods on credit. The purchase of goods on credit. Let it be rupees 10,000. We had assumed of the goods that are purchased on credit rupees 10,000. Earlier, current assets and current liabilities were 20,000 and 10,000 respectively. Now, after the purchase of goods on credit, this purchase of goods will increase the inventory of the business, that is your current asset. So, current assets will increase by rupees 10,000. Now, goods are purchased on credit. This is a short-term credit, so this will also increase your current liability, 10,000. Now, this will be 30,000 and 20,000. New ratio, 30,000, 20,000. That means 3:2. So this will be 1:5 ratio 1. Before this transaction, the current ratio was 2:1. But after this transaction, there is a purchase of goods on credit. There is a decrease in the current ratio. So this transaction will decrease the current ratio. Now, third is sale of a computer having book value of rupees 4,000 and selling price rupees 3,000. That means a computer of rupees 4,000 has been sold for rupees 3,000. Now, what will be the effect of this transaction on the current ratio? So, we will now take it like this. Sale of computer. The book value of the computer is rupees 4,000. What? It has been sold for rupees 3,000. That means there is an inflow of cash by rupees 3,000. So this inflow of cash will increase the current assets. This will be added to the current assets. And computer is a part of the fixed assets. So that will not affect your current assets as well as your current liabilities. So no effect of this transaction on the current liabilities. Now, current assets shall be 23,000, whereas current liabilities shall remain at rupees 10,000. Now, new ratio, 23,000 ratio 10,000. 23:10. This is 2.3:1. From the current ratio 2:1, we had arrived at 2.3:1. That means there is an increase in the current ratio due to this transaction. Now we will take another transaction. Sale of goods, cost price rupees 10,000 and selling price rupees 11,000. Sale of goods. Our current assets and current liabilities. Current assets were 20,000 before this transaction and current liabilities were 10,000. Now, sale of goods. Cost price rupees 10,000. Cost price of rupees 10,000 goods worth will decrease from the business because these are being sold out. So this will decrease current assets by 10,000. We have to deduct it. Now, in lieu of this goods, we have received a cash of rupee 11,000 because the selling price is rupee 11,000. So this will also increase your cash. No effect on current liabilities because cash is a current asset and stock is also a current asset. Now there is a net increase of rupee 1,000. The current asset shall become 21,000, whereas current liabilities shall remain at rupees 10,000. Now new ratio after this transaction is 21,000 are current assets, whereas current liabilities are at 10,000. So new ratio 2.1, ratio 1. This transaction also had increased the current ratio because there is a net increase of rupee 1,000 in the current assets. So this will increase your current assets as well. Now we will take another transaction, payment of unclaimed dividend. E part, payment of unclaimed dividend. Unclaimed dividend is a current liability. So this payment will reduce the current liability and payment will also be made in cash, which is the decrease in the current assets. Let it be rupees 5,000. So payment will decrease your cash, that means current assets will decrease by rupees 5,000 and this will also decrease your current liabilities. Now 15,000 are the current assets and 5,000 are the current liabilities. After this transaction, the new ratio will be 15,000 ratio 5,000. So this will be 3:1. From 2:1, we had arrived at 3:1. So this is again an increase in the current ratio. So these types of questions are known as the statement questions. So you will have to find out which transaction will have an effect on the current ratio or other ratios. So we will have to go through these transactions and we will have to solve the transaction accordingly, find out the effect of the transaction on the current assets as well as current liabilities. In this way, we may be able to find out the effect of the transaction on the current ratio. This is what calculation of current ratio as well as quick ratio. In the next video, we are going to discuss various solvency ratios. Till then, thank you.